Welcome, everyone. We're glad to have you here with us today. This is part 2 of our 3-part webinar series that focuses on combining EB-5 financing with other sources, especially financing. Today's topic is going to be focusing on rural financing incentives and rural incentive programs across the United States. And the whole point of our webinar today and the series is to focus on how you can effectively combine EB-5 financing for various project types with other sources of financing. So on today's webinar, we have myself, Warren Oakes, and I am the manager of Baker Tilly's EB-5 financing team. And then with me today, I also have Tyler Inda and Brad Elmer. I'd like to turn it over to Tyler to introduce himself.
Yeah, hi. Good day to everyone who is out there with us, and thank you for joining us. As Warren alluded to, my name is Tyler Inda. I'm a principal with the capital formation team with Baker Tilly. And through that capital formation team, we do a lot of the services, as it sounds, that revolve around capital. So bringing tax credit financing, other guaranteed programs, et cetera, to projects that have capital needs. So pleasure to be with you all today and look forward to talking about rural opportunities. I'll turn it over to Brad to introduce himself.
Thanks, Tyler and Warren. My name is Brad Elmer. I lead Baker Tilly's site selection and state and local credits and incentives practice. I sit in Madison, Wisconsin. Spent my whole career working with some of the public financial resources that are available on the state and local side. So I'm going to talk about 2 programs, PACE and TIF, today that work well in rural communities and in conjunction with EB-5. So look forward to speaking with you.
Great. Thank you, Tyler and Brad. Just as a recap or an overview for today's discussion, we'll be going over why is rural incentives important and attractive to EB-5. And then as Brad just alluded to, we'll be talking about PACE and TIF. And then we'll close out the discussion today with talking about USDA financing incentives. So let's jump right on in. We wanted to talk about, just give you a broad overview of why rural is important in EB-5. As most of you probably know, rural projects are valued and incentivized in the EB-5 program because of the EB-5 Reform and Integrity Act of 2022, or otherwise called the RIA. And in the RIA, there are specific set-asides, meaning that there are specific visas that are set aside for those investors who invest in projects that are in rural areas across the United States. In EB-5, rural has a very specific definition, and we're going to go over that really quickly. The definition of rural means that the project has to be located in an area with less than 20,000 people living there, and it must not be allocated as part of a metropolitan statistical area or a combined statistical area. And in reality, this can lead to some very interesting project examples. One prime example is if we look at Southern California. On the eastern side of California, there is large swatches of desert and mountain. And it's a very rural area just in and of itself. But because those areas are located so close to the Los Angeles, Orange County, Long Beach, Riverside areas, statistically speaking, those swatches of area that are either mountainous or desert are actually combined with the Los Angeles area. And as a result, those areas are not considered rural for EB-5. But there are other areas within the state, just like across the country, that do qualify as rural. But just something to think about as we go through our discussions here. Next, we wanted to touch on opportunities and incentives. So why are we looking at this today? There's a lot of opportunities for developers such as yourselves to combine EB-5 financing with other sources of financing that are focused on rural projects. And when you combine this with the fact that a lot of EB-5 investors are still looking for quality rural projects to invest in, when you bring a quality rural project, EB-5 project to the market, that places you above, slightly above the rest of the projects that are currently vying for EB-5 investors. It's also interesting to note that your project might also qualify as being in the U.S. national interest, as President Trump and even the previous administration was trying to provide a greater focus on rural projects and to support projects in rural areas across the United States. So it had to be looked at on a case-by-case basis. But potentially a rural project could qualify as something that is in the U.S. national interest, which would then result in another type of expedited processing for EB-5 projects and EB-5 investors. Another opportunity that you could potentially be looking at is the project could also qualify for other programs that focus on providing incentives to rural projects. And that's what we're going to be talking about in more detail here on this webinar. Moving over to incentives, like I mentioned earlier, investors are interested in investing in quality rural projects because they then have a specific visa that's set aside for them and their family members. And they also receive priority processing of their immigration application. When an EB-5 investor also invests in a rural project, they qualify to invest at the lower or the currently $800,000 investment level instead of the $1,050,000 investment level. And like I said earlier, there's specific visas that are set aside for rural investors, and currently that set aside is 20% of the annual set aside. So that means there's 2,000 EB-5 visas each year that are specifically set aside for investors who invest in rural projects. Okay, so that covers our background and why we're talking about what we're talking about today. With that, we're going to move over to Brad and talk about PACE and TIF.
Thanks, Warren. So I'm going to start with PACE financing. And PACE is an acronym for Property Assessed Clean Energy. It's a lending program that's geared towards encouraging energy efficiency improvements in buildings and can be used by a wide array of project types and industries. PACE is enabled by state legislation, so this is not something that's available everywhere, although it is available in 38 states plus DC. You can see on the map on our screen there, the darker color identifies those states that currently have PACE financing enabled. And there's some nuances between states, but essentially the concept is the same everywhere. And while PACE can be used for new construction, and often is, vast majority of our projects, in fact, have been for new construction. The concept was really developed for existing buildings. If you think about making energy improvements to, say, an office building, you may go in and improve the HVAC, the windows. You're going to have cost savings, energy cost savings associated with this. And PACE was really developed as a way to finance those cost savings. So you've got upfront capital investment that you need to make. PACE loan gives you the mechanism to make those improvements. You're going to realize savings over the life of those improvements, and those should match or be cash flow positive to your debt service with the PACE loan. There's some key features of PACE loans that make it attractive to our clients. The vast majority of our clients are using this to lower their overall cost of capital. It is a loan program. It's got an interest rate. Most rates we're seeing now are in the low 7s. The way that our clients use that to reduce their cost of capital is by replacing equity in their capital stack with this loan program. It is non-recourse debt, long-term fixed rate. You can go out 30 years, fixed rate for that entire term. And the goal is to push to a little higher loan to value than you might be able to get to with other products. And there's some attributes of PACE that often give you the ability to do that. PACE loans are repaid through a special assessment on your property tax bill. So that they're more like a tax lien than a loan. And they run with the property and not the borrower. So if you enter into a PACE loan, you put in place this special assessment that will repay that loan. You can sell the property, that assessment loan stay in place. And so from the perspective of your primary lender, this loan would have payment priority, meaning that they'd have to keep it current just like they would a tax lien in a, say, a doomsday scenario where they foreclose, but they could have complete control of the asset, sell the asset, and that loan would not accelerate and have to be repaid. So because of those attributes, banks look at it a little bit differently, and oftentimes you can push to a little higher loan to value and reduce your cost of capital. This has been extremely popular with hotels. I mean, I've personally worked on 2025 PACE loans for hotels. It works with multifamily, industrial, senior housing, office. I think hotels have been particularly popular because they tend to have more equity in the capital stack. So if you have a hotel that would be 60 or 70% debt, 30, 40% equity, it's pretty easy to do a PACE loan that's 10 or 20%, replace some of that equity that requires higher returns with a lower cost PACE loan. Mentioned that PACE is enabled by state legislation. Just want to talk a little bit about the process here. So step one is you need to be at a state where it's enabled. Second step is there needs to be a district in place, PACE district where your project is located. This takes a little bit of research, I'll be honest, when you start looking at specific sites. Many states have statewide administrators that are charged with enabling PACE through PACE districts across the state, and they generally do that through counties. Other states, it may just be the large municipalities have districts, so that's something to look at. In rural areas, you're most typically going to see county level districts for your PACE projects. You know, whether or not there's a district, there's always still an opportunity to create a district. It's not a lengthy process, particularly in states that are actively using PACE. So once you figure out that you're in a state that's enabled, you're in a district, there's usually an application process to that district. That's something that we often do for our clients. In some cases, there is a requirement for some energy efficiency analysis. We can help our clients manage that process, and then ultimately we'll recommend running a competitive process with the PACE lenders. There's 5 to 10 good PACE lenders nationally that specifically lend in this space. We would typically package up a project through a loan request and communicate that to the lenders and receive LOIs in response to that. One thing to keep in mind is your primary lender on the project does need to consent to the PACE loan because of the payment priority. I would recommend, socializing your interest in PACE early in the process when you're selecting lenders. While many lenders are comfortable with PACE and in fact like to use it, there are others that just don't get comfortable or aren't willing to sort of consider it. In terms of eligible uses, I'll just point out that while this is geared towards making energy efficiency improvements, there are not generally onerous requirements around that. You don't need to be LEED certified. You don't need to be doing solar. Generally, the baseline is building code, and you just need to be making improvements that exceed, even in a small way, the building code. So common uses we see for PACE are windows, building envelope, HVAC, solar if you've got it. Then many states also include water conservation like low flow faucets or seismic mitigation if you're in a region that's applicable. So we turn now to tax increment financing, completely different tool. Tax increment financing, or TIF, is the most powerful economic development tool that municipalities in the United States have. Every state, with the exception of Arizona, has tax increment financing legislation. It is, I will say, used to varying degrees in different states. And again, with TIF, the concept is the same across states, although there are nuances between states in terms of which taxes are collected for how long and what they can be used for. But the concept of TIF is that a community municipality identifies an area where they want to encourage redevelopment. They create a TIF district, and then taxes within that district are frozen. Existing taxes that were there prior to the creation of the TIF continue to go to each taxing jurisdiction, and new taxes that result from new development in that district are captured by the district and need to be spent within the bounds of that district. This is most often real estate property taxes. In some states, it could include state or local income taxes or sales taxes. Wisconsin, for example, captures all the real estate property taxes that go to the city, the county, the school district, and any special taxing districts like technical colleges. In terms of the uses, Wisconsin is an example. Again, it has a very broad law. Those tax dollars can be used to make a direct payment to developers or project sponsors to incent development. Many states have requirements that it's used for infrastructure. It can still be a big benefit to your project to the degree that you've got infrastructure that is a part of that. A couple different structures that I'll point out. Two primary structures are kind of upfront financing, where a municipality is looking at these property taxes captured by the TIF district and the incremental taxes, and they are actually going out issuing municipal bonds, in anticipation of those incremental revenues and providing your project dollars up front. I'd say this has become the minority of projects. I'd say 95% are the second structure, which is known as pay-as-you-go, here called PAYGO or developer finance TIF. In this structure, your project will continue to pay property taxes as it would have if there was no district in place. But the portion that's captured by the district, some portion of that can be redirected or rebated back to you. And so 95% of the projects that we see are in this pay-go structure where you pay your taxes, you receive a rebate of those taxes. So, instead of money up front, you've got a revenue stream. And if you want to use that money to finance or pay for your project, you've got to find a mechanism, either through a bank or through equity or some other source to provide the dollars up front that can be repaid through the TIF payments. Couple additional comments on the monetization of TIF. Again, I'd say the most common mechanism we see is through the bank loan. Oftentimes, our borrowers are going to their primary lenders and just asking them to recognize that additional revenue over the course of their loan and upsize their primary loan for the project. For larger TIF deals, there are specialty TIF lending groups out there, tend to be a little bit more expensive, but can fill an important gap in cases where a bank loan's not an option. And then I mentioned the bond financing backed by TIF revenues. That would be in the upfront financing scenario. Final thought on tax increment financing. There is what is known as the but-for test. And municipalities universally have this as part of their programs. Essentially, you need to be able to demonstrate to the municipality that's administering the TIF district that this project would not be feasible in the absence of tax increment financing. So generally, that involves sharing your pro forma, showing that there's a financing gap, and defending why that gap is there. Many times municipalities will hire third-party municipal advisors to review those, and so that's part of the process. In terms of rural implementation of these two programs, we've used both widely in rural areas. They're also available in more metropolitan areas. Probably the biggest challenge with tax increment financing in very rural areas is that you'll be in communities that have not used the tool in the past. And there's kind of an education process. This is a discretionary incentive program, so you've got to have a municipality that wants to incent your project, wants to take the effort to set up a tax increment financing district if there's not one in place. So it's challenges associated with it sometimes, but it can also be a critical tool towards completing your project in a rural area. I'll turn it over to Tyler.
Thanks, Brad. As Brad highlighted, TIF and PACE are very powerful tools that can be utilized for many different EB-5 projects. As we talk about kind of rural and the incentives on the EB-5 front to focus on rural communities, the U.S. Department of Agriculture, or the USDA, really is that division within the federal government that oversees grants and lending specifically for rural communities. So we see a lot of USDA involvement in projects that we've been involved in, whether they're EB-5 related or non-EB-5 related. And so it's really important to have a good understanding of the options that are out there with the USDA. One of the nice things in general with the USDA is that although they have many different definitions of rural, unfortunately, which is a complication, really all of those definitions meet the EB-5 definition of rural. So if you qualify for rural under the EB-5 program, you should be able to take advantage of the USDA programs. As you'll see on the slide in front of you, one of the kind of premier programs or most widely utilized programs under the USDA is the 1RD program, which allows the USDA to provide loan guarantees in connection with projects. That definition is 50,000 population and not in a urban, MSA. So obviously a little bit more latitude than the EB-5 definition. So certainly USDA is something to consider. There's a lot of different programs under the USDA. I'm going to try and kind of highlight the 1RD program and then talk about a few other programs available through the USDA to give you a flavor of kind of what is out there and what may be available to your project as you're looking at potential ways to capitalize the project. So as I highlighted, the USDA 1RD lending program is really probably the most voluminous program the USDA provides and the most well-known in that it allows the USDA to provide guarantees on loans to lenders. So a lender makes a loan to the project, but gets a USDA guarantee from the USDA to help support that loan. This obviously gives lenders a lot more comfortability in making loans to projects. The kind of things to think about with the 1RD lending are that the lender can get an 80% guarantee on their loan, which is very attractive, makes them able to lend to projects that they may otherwise not be able to. The loan amounts that can be under the 1RD program vary based on the type of program that you're applying to. So under community facility, you can go up to $100 million. As that sounds, community facility are for projects that are providing essential community services to that rural community. So think healthcare, education. For wastewater and for waste and water disposal, it's $50 million of loan guarantees that are available per project. For rural energy and for business and industry, it's $25 million. Most of the EB-5 projects, if they're not healthcare related, will generally fall under that business and industry and will be capped at $25 million per project. Other requirements with the 1RD program are that for new construction projects, there has to be 25% balance sheet equity. Meaning, hey, when the project is financed and you look at the capital stack, there's 25% equity. That equity can be preferred equity from EB-5 owners, other grant dollars that are coming in and considered equity. obviously owner's equity, et cetera, but you have to meet that 25% kind of tangible balance sheet equity for the project. And the other note is that generally for you to utilize the 1RD lending program, that loan has to be in first position on the collateral it's taking. The benefits of the program are pretty self-explanatory in many ways. One is that it gives the lender an 80% guarantee, so it allows them to generally lend at a higher loan to value than they otherwise would without this guarantee from the USDA. It also allows for long-term fixed financing on the project, so you can get 25-year financing through this program, which is obviously beneficial in terms of stabilizing the debt service that you'll have. It can be a great selling point for EB-5 investors, knowing that the permanent debt is longer than their investment, to help ensure that when we refinance, the limitations on how high the debt could go are in place with the 1RD loan there. And it can be used to basically cover any and all assets. So certainly hospitality falls under the BNI, or the Business and Industry Program. Things to consider if you're thinking about a 1RD loan: it does take a little bit longer to get approved than a traditional bank loan. It's because you go through the traditional bank underwriting, and then also the USDA has to review and approve. There is a guarantee fee and some upfront increased cost for the loan. And then the other 2 points have already really been highlighted, which is generally it requires that first position collateral and that 25% balance sheet equity. So certainly, not every project's going to fit for the 1RD loan, but many will, especially if you're having your EB-5 money come in as preferred equity or subordinated debt. This can be a very nice first position loan to consider. So the process for 1RD is that the loan actually has to be submitted by a USDA lender. So, think of a bank, a loan fund, et cetera. Most of them are approved USDA lenders. They submit the application on behalf of the project to the USDA. The USDA will review, generally ask a few questions during their diligence process and require additional information. And then once the USDA has approved the loan, they'll provide the lender with a conditional commitment saying that, hey, once these conditions are met, you have the USDA approval to close the loan. For example, a condition of that can be permitting, right? You can go in for the USDA approval knowing you don't have building permits yet. That conditional commitment from the USDA may say, hey, this loan is approved conditioned upon receiving a permit for the building. So that conditional commitment will give the lender comfort that, assuming all the diligence gets done prior to closing, that they have the commitment from the USDA to move forward and close. The USDA is not heavily involved in the closing process, so the lender is working with them predominantly in the background to provide them the loan documents and get their approval, et cetera. But they're not generally dictating a lot of the terms in terms of, what you're going to use from a disbursement process with the loan, how your construction contract looks, et cetera. That's all really being driven by the lender on the loan. In addition to the 1RD lending opportunity, there are a multitude of grant programs that are available through the USDA for rural projects. Is Warren highlighted at the outset of this meeting? The Trump administration and prior administrations both were looking to incentivize development in rural communities. One of their avenues for incentivizing development is through the USDA. So each administration generally has different grant programs and consistent grant programs that have been through multiple administrations that are awarded to rural projects. There's community facility grant dollars available. Again, similar to the lending side, those are going for essential community services. There's job creation and retention grant dollars available. as are energy, agriculture, and meat production grants available. And so really, is you're looking at your EB-5 project and considering, opportunities, certainly looking at the USDA grants that are out there and potentially available is something that should be considered. Um, you know, Without going too far into this, grants obviously will come in and there's no expected repayment on those. So they're considered equity generally for, bank lenders and looked at favorably by EB-5 investors, et cetera. The timing for these grant awards is a little bit uncertain in that, the USDA will generally, indicate a time frame for which these grants will be open and a general time frame for when the grant awards will be made. But there can be some variability and uncertainty regarding that. And then also the grant programs, the amount you can apply for versus the amount you get can vary significantly. So just because it says, hey, you're eligible for a $25 million grant does not mean that you'll get a $25 million grant. And generally, you can look at kind of the historic precedent on those awards to determine what's a reasonable number that you'll get. It is important that you're looking at these grants early in the process, because each grant program has slightly different parameters on what's required with that submission. So the level of diligence, business plans, et cetera, that are required. B, you have to register for grant.gov to be able to apply for a grant under these programs. Grants.gov can generally be a 2 or 3 week process to get registered. So if you have to register by, the beginning of December for a grant, well, you have to make sure, you're setting up that grants.gov registration process in October or early November so you can be eligible to actually open the grant in the system by that December deadline. In addition to kind of what I would call the, USDA 1RD lending program and the various grants we went over that are really focused more on business, energy, community facilities, the USDA also has programs catered towards multifamily and significant programs focused on multifamily. There's the direct lending program from the USDA, which provides below market loans directly from the USDA to projects that are focused on low income or moderate income. Generally, the moderate income is about 120% adjusted median income for the rural community that you're serving. Those will provide long-term low interest rate loans that are more favorable than market. There's also a loan guarantee program for multifamily, similar to the 1RD program, that provides a guarantee to the lender making the loan to the project. And there's also rental assistance programs that the USDA oversees. Those rental assistance programs provide rental assistance to tenants that are using USDA financed projects. So in addition to potentially getting that, direct loan from the USDA that's below market for a multifamily project, you can also then apply for rental assistance through the USDA, where they'll support, rent payments that tenants should be making to the project on a go-forward basis. So really, across the spectrum of EB-5 projects, there's opportunities within the USDA. Each opportunity has obviously its specific complications, but is certainly something that should be considered when looking at rural projects. Outside of the USDA program, and I know we have and will have other kind of web series that get more in depth into these, but other federal programs to be mindful of are one, the New Market Tax Credit Program. That program provides favorable consideration to rural projects. The program sets aside a certain amount of New Market Tax Credit allocation for specific rural communities. So you're more likely in a rural community to get an allocation than you are in a metro community. And then the new laws related that were put in the One Big Beautiful Bill related to opportunity zones create favorability for rural communities as well. One is that in non-rural communities, you will get a 10% step up in your basis. So with opportunity zones, if you invest a capital gain, you defer the tax on that. If after 5 years in a metro area, you would step up that basis to 10%. So you'd only be paying taxes on 90% of that investment after it was deferred. In a rural community, that basis step up is 30%. So you'd only be paying taxes on 70% of that deferred gain. So a pretty strong incentive for opportunity zones to go to rural communities. And then also in rural communities under the opportunity zone, there's only a 50% improvement requirement for substantial improvement thresholds compared to 100% improvement in non-metro areas. And what that means is under OZ, if you bought a building for $1 and it was in a metro area, you have to make another $1 of improvements to that building. So you have to improve the basis of that building by 100%. In a rural area, if you bought that building for $1, the basis improvement would only have to be 50% or 50 cents to qualify. So another huge incentive under the new opportunity zone rules. Those rules will not take effect until January 1, 2027. So just be mindful of that. But certainly a lot of potential incentives here and opportunities to consider when looking at rural investments. With that, I'll turn it back over to Warren.
Thank you, Tyler and Brad. We're very glad to have had this opportunity to speak and share all this information with you guys. And we hope that you learned a lot from it. The goal wasn't to give an exhaustive understanding of these programs, but to just give you an understanding of how these programs can potentially be used effectively with EB-5. We definitely welcome you to reach out to us at any time with any questions you might have about this. And we look forward to working with you on your projects to effectively combine these very interesting and effective programs with EB-5. With that, please feel free to reach out to us at any time. And we look forward to seeing you at next month's webinar that discusses combining EB-5 with new market tax credits. And we hope you have a good rest of your day.